Hello, my name is Suhas Patil. I'm going to go over today the stock trends and how to discover trends using an indicator called MACD, moving average convergence divergence. And I'll explain the theory behind it, a simple theory, mathematical theory behind it for you to understand, and how we then you use this base on several stocks to really understand how one can really analyze the stocks. What I'm showing you here is the date in column A. It goes from 26 February 2020 to um, 1st of May 2020, last year. And this is currently showing you some stock values in the closed column. Uh, and this over a period of the same time frame. Okay, I'm going to go over now the two concepts of moving averages and then MACD later on separately. Let's look at moving averages first. So you know what the average numbers are. You simply take two or more numbers, you sum them, and you divide them by the number of numbers that you have. So for example, average of 10, 12, and 14 is 12 because 10 plus 12 is 22 and so on, right? Simple. Okay. So moving average is the average on a specific date for previous periods in that time frame. So for example, if I say 12-day moving average, it means from this day, 12 days behind it, I'll add the numbers and I'll find the value. So for example, on this part here, let's say on this value, to find the 12-day moving average, what I'll do is I'll go back 12 days here, for example, or whatever that number is, and then find the value and then write it here. Okay. Now there's a slight twist with the extended exponential moving average. Exponential moving average essentially gives more weightage to the latest value than the previous values. So for example, again, the same example of the 10, 12, and 14. Now, the value of 10 has the same weightage as the value of 14 when I find the normal average. Whereas in the exponential moving average, the value of 14 will have more weightage, and hence it will be more towards the 14 than towards the 10. So in the same example, if you find the exponential moving average, it'll be maybe 13 point something as opposed to 12 in the normal average. Okay. So what I'm showing you here is now um, a stock price in this pink color in the same time frame. And then I'm showing the moving average values in here, in the blue dots, the blue lines here. Okay. Now let's look at, for example, this number. This is the average of B2 to 13, so meaning these numbers from here to here. This is the average of that number. And then from now on, we find the exponential moving average of the previous days. So this is basically a summation or a weighted sum of the previous values and the latest value, 6570, which is the B14 here. And then you find these values. So you find such values for the period of time. And by the way, this spreadsheet is also shared. So you can make a Google Doc out of this, make a copy of it, and you can play with the numbers and see how the values change. Okay, so we find the 12-day moving average and in this part here. Now what we do is we add one more series analysis to this, and we add a 26 days moving average on top of that. Again, the same concept. So this value here is a summation average of average values from here till here, or 26 days. And then Beyond this, we find the exponential moving average again of these two values. Of this value, the latest close value, this one, and then previous ones. We look at this numbers here, right? Now this is higher than this value. For example, this value, because as we said, there's a weightage given to the previous values also. So there are some numbers that are high numbers here, and hence this value of 68 is more than 57 value in the exponential moving average. Okay. So again, what we're doing is we make the average numbers here, plot this, calculate the values here, and then plot them on this chart. Okay. And why are we doing this? Now let's look at why we are doing this. So a 12-day moving average essentially says the values that are in the last 12 days, you find the average, and a 26 days average values are going beyond that price time, and gives you a kind of a what's called a slow moving average, and a 12-day moving average is a fast moving average. And the reason is any change that happens in the stock price today will reflect more on the 12-day moving average than it reflects on the 26 days moving average. I mean, simple mathematics. Basically, average of a large number of numbers will be always dampened by the number of samples that you have. Whereas if you have a smaller number of samples, it is very easy to skew that number very easily, quickly, right? Okay. So, and the interesting part about this is now when the stock, any stock starts changing the direction, let's say a stock is kind of just doing up and down continuously, right? And at some points, it starts going up in your in the charts. For example, a Reliance stock, when they announce Geo service, or um, there are many stocks that you can find that are in the upward trend, and you can really make good money in stock market only when you find the uptrends in the stocks, and then for a company that is having strong fundamentals. All right, now back to the um, concept of the moving averages and so on. Now, when the stock is going up and down like this, it is long-term moving average, which is the 26 days moving average, will be almost similar to the short-term moving average because it hasn't really moved. So it will be almost in the same band of these prices. But when the stock is kind of in that band, it'll both will be similar. The 12 days moving average and the 26 days moving average. So the difference between these two will always be almost zero, almost zero. Now, now let's say the stock starts to move up. Now what will happen to the 12-day moving average is that it will start moving up faster than the 26 days moving average. And as a result, you'll see a separation between these two values. So the 12 days moving average will be higher than the 26 days moving average. And that's exactly what you're seeing here on this chart. So around this day here on 6/4, the difference between these two is almost same. So 6/4 is somewhere here. Here it is. Um, so the difference between these two is, okay, I'll explain to you how MACD actually means the difference between these two. But this is where the difference is. So essentially at this point, the trend has reversed in the stock and the stock is now moving up. So it is actually moving up. So, but if you really see visually, the stock actually started moving sometime somewhere here in this zone. But these trends are always what's called lagging indicators. And so this is not happening. They're not forward-looking indicators. They're lagging indicators, meaning they'll explain to you what has happened in the past and what kind of trend has been established in that stock price. Right? It doesn't tell you what is going to happen in the future. It is still important to understand that the trend has been established one way or other in the stock. Now, now there are enough cases where a trend gets established and it gets broken again, and the stock falls rapidly. And so, just by looking at the trend is not good enough for you to buy a stock. But point is, uh, at least you will know to focus on certain stocks to pay attention and maybe make a decision about buying or not buying it, depending on the trends. That's why the trend is important. So, what has happened here on this cross point here is um, the 12-day moving average and the value of 26 days moving average is similar, almost same, and hence is zero. And so MACD, the indicator you can look up on Google and understand and more in detail and so on. But MACD essentially is the difference of these two values, the 12-day moving average subtracted by 26 days moving average. So 12-day minus 26 days is what the MACD indicator is about. Okay. Um, So now this indicator is essentially also what is plotted here in the chart below. But let's to understand that more in detail, let's look at the Yahoo Finance chart. So Praj Industries has been going up for a long time. And the trend in Praj Industries started sometime in, um, if you really see, the trend began sometime here. The actual trend started here in the June of 2020, almost a year back, when the price was $61 or rupees, and now it is 284 rupees. Now, if you look at this is the MACD line, or the difference of 12-day minus 26 days moving average. This is line, and this line is essentially goes over zero line, which is this line here, horizontal line. When it goes over zero here, this is the point where the trend has been established and has been detected by the MACD indicator. So you're always going to lose some of the gain that you would have got here if you somehow knew ahead of time that the trend is changing. But if you look at the previous trend, it's almost impossible to detect a trend here that is going up. In fact, it's going downtrend in this manner. But at this point here, the trend has been established to be positive trend. And so from here onwards, now imagine you had some way of looking at this stock, and somebody had told you about this indicator turning positive for this stock, Praj Industries, last year in June of 2020. You could have studied the company and maybe made a trial buy, or maybe made a studied the news and made a significant investment there. What would have happened is from 61, you would have gone all the way to 284, essentially, as of today, because the trend has pretty much stayed positive in this entire period, except for the small change. It's pretty much stayed constant and moving positive, and hence the stock is continuously in the upward trend. Rather, because the stock is in the upward trend, the MACD indicator has stayed above zero. So this is a simple way to look at the trend and really identify a stock whether it is trending upwards or not. So clearly, at this point, Praj Industries is in an upward trend. Clearly, the trend has gone away from Reliance at this point, sometime in the March of 20, in the month of March of 21, and it is not really going up. Okay. There are more to the, so you can't simply look at the upward trend and decide to buy, or a downward trend and decide to sell. There's more to it, but essentially this is a way to kind of understand which way the trends are moving. Now let's add some more complexity in this analysis. Now, having done this, okay, so we already discussed about the difference between these two numbers, the 12-day EMA minus 26 days EMA, and we said that number is called as a MACD number. And so what we do is, so the difference between these two values, from here to here, from here to here, from here to here, and so on, we plot them on another line, and that is the MACD line. That is this line here, for the same price, for the same stock. And if you see the change in MACD around here, from negative value to positive value, it happened on the 6-4. So again, we saw earlier also 6-4 is also always coming up as a number, and here's where that value was, MACD. Okay, so so you don't need to go and look at the subtraction of these two numbers, or you don't even need to look at the two numbers here, the two values here of 12 days and 26 days moving average. But all you got to do is look at the MACD indicator, which is this value, and then you know that either it has gone into bullish direction, or if it is crosses downward, then it is a bearish direction. It's a falling trend. Okay, and this is the indicator that's plotted typically in quite a few stocks tools. Yahoo Finance is one. Any of these tools, let's say Zerodha or Sharekhan or Upstocks, will have such charts for you with the MACD indicator plotted. All right. Now, let's add one more complexity. Now, what you do is, now we want to find out how the MACD indicator itself is going to move. In other words, how this divergence between these two lines, 12 days minus 26 days moving average, has been behaving. So what you do is, to now understand that part, we do an average of 9 days of MACD values. So to get the first point here, we go back 9 previous days, 1, 2, 3, 4, 5, and so on, and we plot this point here. And similarly, then we go and plot the next point by going, 9 days backwards, and then again 9 days backward, and so on. And we plot these lines here, this line here. Now, this is called the signal line. Now, signal line essentially means how the MACD line itself is moving, or changing directions and stuff. So at this point here, you can see that the MACD line itself has been crossed over by the signal line here. So this essentially changes the direction of um, the trend in the stock prices. So this would be around 21.4. So 21.4 is somewhere here, this line, and this is the value here. So 21.4 again is right here. So this is a point at which the price has actually begun to drop. So in this upward trend, so it is doing this, an upward trend and going down, but in that upward trend, it's now in the downward direction, kind of stuff. I mean, if you can study more, I'm overly simplifying it, but study more on Yahoo or on Google and other things, and you'll get clarity about this. But this is the basic understanding of MACD indicator and so on for finding trends. And we are using this indicator to do more analysis later in several stocks. So I hope you understand. I hope you understood the basic concept. And if you like the concept, write your feedback. Let me know what you thought about it, and also please share with your friends. Thank you.